good to have with us Jiro Yasu, the director of Varecs Partners, an investment advisory firm based in Tokyo. Yasu-san, welcome.
Thank you for coming.
Really love to hear about where you're finding opportunities in Japan. Before we do that, perhaps you could share with our audience a little bit about your background and how you got interested in investing.
My family runs a brokerage firm for over 70 years. My father is third generation, and then I was supposed to be a fourth generation, but that's my first connection with the financial industry. My great grandfather started the company called Jiro Securities. This building is owned by the firm. He was a writer of the newspaper, and he was responsible for market movement, and then that's, I guess, my family started involving the financial industry. And then he got money to start his own brokerage firm because he talked about a little bit his view on market in the article, and then some wealthy guy found maybe he's a good guy to run the brokerage firm because he's so correct on the forecast. That's how he started the business. And then our firm has grown after World War II. I guess my father's firm was involving a lot of proprietary trading and investment. There's a few very successful investment they made right after World War II. One was there's an exchange of old yen to new yen, and then government to cope with the hyperinflation. Government decided to change the yen, and they closed the access to the bank, so the individually only can withdraw money. I forgot the exact amount, very little money every month. So if they needed money, they came to a brokerage company to sell their shares, and then we paid in the new yen, and then we bought the shares at the steep discount from the way it's trading, and then that's kind of an arbitrage the firm did, and then we made a good money. And also my family and the brokerage company invested the GHQ, which acquired a stake of a lot of Mitsubishi. We call it Zaibatsu, but and then they broke them up, and then they sold the shares, and then the company found some value in some companies. So the when GHQ made an auction to sell the shares, my family was very active to bidding for the shares. And then so that's my family is very in the industry way before I was born. So when I graduated the college in Tokyo, I asked my father what should I do after the college, and then my father's firm had a close relationship with Daiwa Securities. So father and I asked Daiwa's CEO, what should I do, and then he arranged a job for me to work for Daiwa's New York office. And then so right after graduating college, I went to New York for working for Daiwa. The first couple of years I worked there, U.S. equity trading sales department, covering some Japanese clients and some executing some trades. But I was not so. I didn't find it very interesting doing that. So I was looking for another opportunity in New York, and then first Seagull, then it was called Anhold and Supply Shoulder, was one of the clients with Daiwa. So I got a job working for them for free for 2 months because of visa issue. I couldn't get paid, but I had some savings. I went there for working for free, and then I worked for several different departments. And then after 2 months, they gave me a job to work there. So then 1998, I joined Anhold and Supply Shoulder. Now I was very young, very junior guy. So I did everything, whatever I can do. one of my duty was raising money for first legal products from Japanese institutional clients, and then so I raised some money for the internal funds, and then and I got different other responsibility. One of was I was a member of the team which run the internal fund of funds, and then so I interviewed a lot of different managers, and then also after a few years I joined the First Eagle. We acquired John Ray's Everell's team from Social General, and then they brought in the very value investment strategy and philosophy to the firm, and then because they were investing in a lot of Japanese names, they always come to my desk and asking, do I know this company or that company, and then also I was involved in running a fund of funds side of business. So I interviewed a lot of value managers, including your former firm, and then that was until like 2005. And so I was doing a lot of different things at First Eagle, raising money, involving some investments, and then fund of funds management. And then in 2005 I came back to Japan because my father asked me to come back. He was a little concerned, maybe my son never come back. So, but I agreed to come back in '05, and then so I joined my father's firm as a director. But after 6 months or so, I found there's very little opportunity running a brokerage firm in Japan. So I asked my father to shut it down. So it took a years, but we sold most of the business in '07, and then we shut down the last piece of business last March. So that's what I did for my family business. But the 1 year after I came back to Japan, I got bored again, and then I wanted to do something, and then I wanted to start investing in some Japanese equities. So I asked the First Eagle, my family, and a few of my friends to give me a seed capital to start a fund. So in '07, '06, May 02, '06, we started the Varecs Partners, and then we started a fund in December '06. I think that's about it.
So there's a lot of talk now, and has been for a while, about how it's difficult to make money in Japan. The sentiment is so negative. I'd be really curious, given your background and perspective, to hear what do you think is wrong with that view, perhaps, and what are some of the misconceptions that foreign investors have about Japan, and what's the reality on the ground as you see it? So specifically for your fund, where are you seeing the investment opportunities? What are areas that where the market and the perception is really different from reality?
Well, I think our focus is smaller companies. We usually invest in less than $1 billion companies, maybe as small as like only $50 million companies. And then we made a lot of mistakes, but there's some success in the past. And then if I think over that success, I guess there's a few in a way to make money here. The one is you have to find right management first of all, and then we always ask. So to identify the guy's right guy or not right guy, we always talk about discuss the fair value or intrinsic value of the business that the CEO run. So we go through our valuation models, maybe put some multiple and the EBIT level they can maybe maintain easily, and then we discuss about the fair value or intrinsic value of the business. And then if the CEO has some sense of understanding the value or understanding the way we come up with the value, maybe he has some chance to be a great management people for you, because if we can agree on the value of the business, and of course, as a value investor, we're investing with the company, so it is very undervalued. So if the CEO agree with it is very deeply undervalued, there's a good possibility he will do something to close the gap. But there's a lot of management in Japan who have no sense of what's the right value of the business. And then, if the company or share price is deeply undervalued, maybe those investing in such companies is not so good idea. So we always try to talk to the CEO. What's the right price for the business? How do you value the business? And then we sometimes see some management people who has no sense of valuing company. He might make stupid acquisitions. He might overpay to buying some silly business. But if the management has good sense of the value of the business, and then he sees his share price is deeply undervalued, he might buy back some shares, and he understands why it works and why it's good for the shareholders. I think that's the one thing we found out is very important. There's a two type of management here. One guy who doesn't really care about the business value, but the other guys who has some sense of the value of business. I think that's the one thing you need. So there's many companies which are undervalued, but you invest. Maybe they will be there. Maybe remain undervalued for next 20 years. But if you find the right guy, right management who understand the shares undervalued, I think that's a good investment to make, even in Japan. Maybe I can talk about a little example. There's one company we had an investment called Tokai, Tokai. They provide various services to hospitals. They provide linen supply. They make cleaning, or they do they run the cafeteria in the hospital or something like that. So they help the hospitals. But 5 years ago, when we met with Mr. Onogi, who is the CEO, he has very clear view why his company is undervalued. And then he gave us 3 reasons why the share price is undervalued. The one is his father, the former CEO, the father invested over $300 million to develop the couple golf courses, and then one big ski resort. And then so the son, the current CEO, he understands that's not good things for that makes company very complicated. If investors sees there's a growth potential for the healthcare business, maybe they don't pick the Tokai because he has big assets in the sports business. So he said, we got to get out from this business. And then the second reason he gave us was the share of Tokai was listed on Nagoya Exchange, not a Tokyo Exchange, the regional exchange, very limited volume. Some institutional investors were not even allowed to invest in such shares. So he said, we gotta go to a Tokyo Stock Exchange. That's the second reason. And then third reason, because the company has been written off sports businesses, it doesn't have enough retained earnings. So its dividend is very hard to pay dividends. The dividend was very small. And then so he said, we need to fix the business portfolio. We need to go to Tokyo Stock Exchange. And then at the end, we gotta start paying something to the shareholders. And then after 5 years, and then share was, and then the balance sheet was a little levered because of the business sports business developments and etc. And then, but last 5 years, he said exactly what he told us 5 years ago. So he sold his sports business to the Goldman Sachs, the fund, and he shut down the ski resort and then gave to a local prefecture, local government, and then also he moved to a Tokyo Stock Exchange, and he just started paying dividend to the investors. So and then the share price was doubled in 5 years. So and the share price is very undervalued 5 years ago, maybe trading at the 2 or 3 times of EBIT, and then way below the net assets. And then, but after 4 or 5 years, I think it's still undervalued. But the and then he has more room to. I guess he has more tool to do something, because his balance sheet is large net cash, and then the company is maintaining like 10% on return on equity, but as free cash flow grows and the cash balance grows, return on equity will start declining. So he's very aware of that issue. So I'm sure he'll use some cash to buy back some shares or start paying dividends. So I think that's a good example, betting on right guy, right?
How much of a stake does the management have in that?
We found it that he has about, I think he has about 20% or so, and then we found that there's a right. If the management has no stake, that's not so good. But if the management or founding family has too much stake, that's not good also. So I found it's like 10 to 30% is a kind of a right balance, right the sweet spot of the CEO ownership. We had an investment with a company called Nagai 11. They makes the nurse uniforms, and then they're actually a client of Tokai, but the Tokai is a client of Nagai. So we founded the company through them. But Mr. Sawanobori-san, he has about 20% or 15%, and then that kind of stake is a right stake, because that's most of his personal wealth. He does care about the value of his stake, but also he doesn't have a veto or controlling stake, so he has to listen to what the other shareholders says. So I found it that's 10 to 30% the kind of right the ownership.
And what is that upper limitation, and when do you have blocking rights or control? Can you give us a sense of what are the rules?
Well, if you have more than a third of 1/3 of the stake, let's say if you want to sell the company in Japan, you need a voting more than 2/3. If you have more than 2/3 of the shares, you can do anything you want to do with the company. And then if you have more than half, you can control the board, and you can send board members to the whoever you want to the board. And then, but if you have more than 1/3 of stake, so you can veto the company to be sold. So like the third and the 50 and 2/3 is a kind of threshold for important stake.
So ideally, the stake is big enough so that it's important for the CEO in terms of the personal wealth.
Right.
And then you don't want it above 30% really, where you could have blocking.
I don't want to have, it's not a strong thing, but if he has more than 1/3, he can personally veto. If let's say that somebody show up and try to buy the company with 100% premium, but he can veto to the offer. So if he has more than 1/3 of stake, maybe he may stop listening to other people, what other people think. So.
And you mentioned so it's important to find out about whether the CEO understands the concept of intrinsic value and capital allocation. Now, does that require meeting with management? What can one get from the disclosures and the filings?
Right.
What would you do just for our audience who are perhaps in the
Right.
US or Europe, if you pull up filings on a Japanese company, what would you look at first? Can you describe the process? Also, starting with the basics, from even, can you give us a sense of what is available in English for what types of companies, or where could one find the disclosures? And
what is available in English, I'm not so sure because I can read Japanese, so I don't want to look at the English disclosure. But the we always request a meeting with the CEO, but the many cases they don't. CEO doesn't want to see investors. So we found it that's not a good sign. And then if he doesn't want to see the shareholders, maybe we need to own some shares before we meet with the CEO. But the if CEO doesn't want to see the investor, we see it maybe likely he doesn't really care about the investors because but the smaller company, like if you're talking about like a couple $100 million market cap company, if you ask politely, maybe please, can we see management, and then he'll show up. Most cases they'll show up, but I found there's maybe some cases the CEOs are a little shy, especially when he needs to speaking in English in front of his colleagues, and maybe that could be one reason why the guy doesn't want to show up to the meeting. But in terms of process of valuing company, first of all, we like a very profitable business, of course. We tend to look at the operating margin. We love to invest more than like 25 operating margin type of business, and then we usually find such companies, but when the company has such a high margin, share price is not that cheap. So we did some preliminary work, try to understand why they can maintain such a high margin, and if we find there's some reason the margin will continue, maybe we put in the watch list or something. And then sometime the company may disappoint investors, and then in Japan, a lot of sell side analysts, buy side investors, they too much focus on year over year increase or decrease of profit. So if the company has one fiscal year has negative growth, and the share price can go down largely. That gives us chance to buy such a very profitable business at the very cheap discount. We made an investment with a company called Nakanishi. They make the handpieces for dentists. They have about $250 million sales, but its operating profit is like a $90 million or so. So like 30-35% type of margins. And then we've been looking at, we like the company for such a long time. They're always top of our wish list. And then right after they have December fiscal year. So beginning of 09, the 08 result was okay, but their focus for the 09 was very large decrease of operating profit. So the share price came down from like 12,000 to 6,000, and then EBIT multiple came down from like 6-7 times to 3 times. So and then we check a few things. We try to understand why the profit declined so much, but we found is we are somewhat comfortable with the company. If the sales come back a little bit, the operating leverage will kick in right away. So we made investments. So Our first process always start with the profitable business. Try to find the highly profitable business in Japan, and then wait until the share price comes down to the area where we are comfortable to invest. And then while we are trying to understand the business, we visit the company. And in Japan, most of the public companies host the analyst conference, analyst meeting 2 times a year. So we go to such meetings, and then we visit the company. And usually there's IR guy show up, so we meet with IR guy a couple of times and try to understand the basic. And then maybe we invest small money, and we request a meeting with the CEO. And or maybe if we cannot meet with the CEO, we can ask a question at the analyst meeting. So that's and then we try to. So if they're dentist products, we love to talk to some dentists in Japan. And then lucky enough, my neighbor was dentist, so I visit his house and home apartment and ask about the how things work in Japan. So and then if we can, we want to talk to competitors also. Especially if the competitor is a private company, and then if we can find a way to talk to them, it's very helpful because they're not a subject to fair disclosure type of thing, so they can literally talk about how industry works and how they see about the products. So that kind of things.
What would you say are some of the current areas of opportunity that you see, or can you mention 1 or 2 names that you find particularly attractive today as an investor?
Well, so I found it in Japan, the people are very short-term oriented. So if the company has good full 5 years business plan, nobody cares. So I found that's great investment opportunities for us as a long-term investors. Like 4 years ago, we made an investment with the company called EM Systems, which make computer software for pharmacies, prescription pharmacies. And then the company's share price came down from 3,000 to 1,000. And then the reason were very simple. They were selling a computer for one-time charge of like $30,000, but they found that makes business very volatile because their annual sale depends on how many software they sold. And then when the prescription pharmacies are growing, that was okay. Their sales is also growing, but the prescription pharmacy got somewhat matured and not many new openings, and their sales start having tough time to grow. So they changed their business model from selling instead of selling at 30,000 grand at the beginning, they sell it at the $10,000 and start collecting monthly fees. And then so we found that's we like kind of stock type of business and a stable cash flow type of business. So we found that's a good change. But the of course the market, because they used to sell at 30,000, now they are selling at 10,000 for the first year. There's obvious they'll lose money for first couple of years. So share price, that's why share price came down from 3,000 to 1,000. And then so we built some, do some very simple work, and then we concluded the company will start making money from the third year, but first year and the second year they lose a lot of money. So we when share price reaches 1,000 yen, we are very slowly buying shares, and then the share price kept going down until 400. So even more than cutting in half. But we kept buying, and then but then last year the company made a decent operating profit, and this year operating profit doubled, and next year maybe double again. So the share price came down from like 400 to right now like 1,600. So if you can make long-term investments, and then you can live with the such short-term, market-to-market loss. I think that there's a big opportunity to make money in Japan because nobody cares about the mid-term, 3, 4, 5 years business plan. Even they don't, like EM systems, they don't change their business. They just change the way to count the money. So, but then nobody didn't really understand what they want to do. So I even suggested the company to go private once because they will have tough time explaining investors also. But they said no, we don't want to go private. They want to keep the company listed. So we said that's fine, but so we'll live with it. So
what do you think is this company worth? Do you still own it?
We still own it. There's another element of the company. It has nice building in front of Shin Osaka station, and then they spent about 11 billion yen to build the building, and then if they sell the building right now, maybe it's 10 billion yen or so, and the market cap is about 15 billion yen today. So the 10 billion is a building. So you're only paying 5 billion yen for the business, and the companies will make 2 to 3 billion yen EBIT in coming years when they finish business model change. So you're paying maybe 2 times EBIT, and then the business will be very stable, very cash flow generative business. So we don't own as much as before, but we're still a shareholder of the company. We still see, and then the management understand the value of the business very well too.
So what about this building then? How does management rationalize paying for this building
they
in
don't
the first
have
place?
right.
What about that conversation with them?
Right. They have no rationale to owning a business, owning the building. There's not their business. There's like 14 floors or something. And they only use 2 floors for their own office, and then so 85% or so they rent them out. So and they don't have no rationale still owning a building, but they don't want to sell at the lower price of what they pay. So and as they wait, there's some borrowing for the building. So as they wait, borrowing is still coming down. So they know building will be 100% of theirs in coming years. So I wish they will sell. And then we put some very conservative cap rate when we buy the building. Maybe in the UK people are putting like 4.5%, 5% cap rate. But when we come up with a 10 billion yen for the building, we put like a 8% cap rate or even maybe 10% cap rate. So so I don't want them to sell at the very cheap price, but I hope someday they will sell it anyway. So there's no rationale to owning the building. Right? But there's another firm. Speaking of a long-term investment in the software and real estate, we have investment with a company called Obic Business Consulting. They make accounting software for the smaller businesses. They have like 50% market share. Their sales is like 18 billion yen, but their operating profit is like 7 billion yen or 8 billion yen. It's a very highly profitable business. And then their market cap is about the 80 billion yen or so. But they have 30 billion yen in cash, and also they have like 30 billion yen in investment portfolio. And then they invest in REITs, and then they also invest in in Japan there's a stupid, it's a very silly retail product. The product pay monthly distribution, and then Obic also has money with such a product. And then we like the business because so they 50% of their clients paying maintenance fee, and then we in Japan we're gonna have increase of consumption tax in coming years, and then we are hoping expecting the maintenance fee 50% maintenance ratio will come up because we're gonna have consumption tax rate a few times in coming years. If the clients doesn't sign up for the maintenance, they have to buy the accounting software one more time. And then if there's a one-time consumption tax increase, maybe some client choose to not sign up maintenance agreement and just buy the new software. But we're gonna have increase of a few times. So and every 10% increase of maintenance ratio, we'll see a big jump on the operating profit. But nobody cares because it's just the consumption tax will be increasing next 2 years. So people in Japan only care about next year or maybe this year or next year. So they don't really care. So but we can invest in long term, so we made investment with the company. So
what do you think is perhaps when it comes to Japan and how foreigners look at it and some of these misconceptions, what do you think represents the best opportunity then to take advantage of that?
Well, so we until now we talk about the betting on investing with the right people, but the same time there's many companies traded at way below their net cash, and then and even the management doesn't really understand the value of the business. But there should be some price for the company, even discounting, such problem issues. So if you take a look at the company called like Chofu Seisakusho, its market cap is about how much? I think it's 60 billion yen or so. Anyway, it's about 60 billion yen market cap. Yeah, 62 billion yen market cap. But he has cash and securities of about the 80 billion yen. So and then he has stable, profitable business. And then they make a water heater, by the way. But the so right now enterprise value is a negative 17 billion yen. But if we can take over the company, it's a it's easy way to make money. But we can because their insiders control the more than a third of the stake for the company. But the so and then the management doesn't really understand what's the right value for the business, and they don't really understand benefit of buying back shares, and then they don't really increase dividend. The management only focus on running day-to-day business and increasing market share, and that's fine. But I don't think this company will be valued at the decent multiple. Maybe if you sell the business, you can sell the company at maybe 7 times, 8 times EBIT easily, but that won't happen anytime soon. So our approach to such company is try to buy the company at the deeply undervalued price, like a 20% discount to net cash, and then sell at net cash, and then or maybe 1 times EBIT, and then we find it's the risk you are taking is very low. At the beginning you are paying less than cash anyway. So I think, but you should not wait until the company will be valued at 6 times EBIT. But that's not going to happen until the management change how they allocate the capital and how they see the value of the company. But there's a very low risk way to invest in such company. Buy big discount to a net cash, and then sell at net cash or sell at the little bit higher than net cash.
So this notion that if one does a screen and there are all these opportunities that are cheap on a balance sheet basis, trading below cash, let's say, you're saying, well, one should adopt more of a trading approach,
Right.
versus just hoping that somehow, someday, the full value gets realized.
Maybe that might happen. So it depends on the how you see the management. If you see there is some chance, maybe small chance, the company may change the way they allocate the capital. If you see there's some chance, you should keep some shares as a long-term investment. But but I don't want to sell a trading idea, but but buy at deep discount, deep value price, and then selling at the maybe value price is maybe right strategy for some names in Japan, I think. But you have to judge whether management is right management or wrong management. So nobody is a kind of black and white. Everybody is a kind of in between. So you have to adjust your intrinsic value, discounting, such management, not a skill set, but the ability to understand such things.
But if we then take, for example, the different buckets that are perhaps available in Japan, so one would be, let's say, the Ben Graham nets.
Right.
The other bucket is these good businesses with good management, not trading at really cheap prices, maybe are trading at attractive prices. And then you have the, let's say, big companies that everybody knows, like the Sonys, for example,
Right.
that are undergoing some turnaround and could be interesting based on turnaround scenarios. Where do you see is the best opportunity?
Well, the first two, where we kind of invest. So even the management doesn't really understand the capital allocation, or we love to invest such names if the price is right. So we love to invest Shofu Seisakcho at 20-25% discount to the net cash, and then at the same time, maybe Buffett like business with a better management, like a Nakanishi, the dentist handpiece company. We love to invest maybe 3-4 times EBIT. That's even very cheap in global standards. Their competitor, Kavo, the German company, was acquired by Danaher, US company, and Danaher paid like 6-7 times EBIT. And then Kavo has very low profit margin than Nakanishi. I think Kavo margins was like a 13-14% type of operating margin, and Nakanishi is like 35%. So even applying that multiple Danaher paid to the Nakanishi, even you pay 3-4 times EBIT is very good price, I think. So I think those two area is very attractive, I think. And then like a case of Nakanishi, and even Japanese domestic economy is not that great. Those companies can grow overseas. Nakanishi, their sales, also 80% of their sales is coming from overseas. But the last part, like Sony, Sharp, even maybe Panasonic, I have no idea how they can come back to profitability, and then I don't know how they will survive going forward. So that's even Nintendo. Nintendo is sitting on large cash, so they will not, they'll keep it going, for a very long time. But I don't know how they can compete with the, that's technology type of things. We have very less visibility and no idea, so we don't really invest in such a very one of the problem was the the product life cycle is very short. So even maybe Sony come up with a great product, and then you make huge money for the 1 year, but next year you have no idea. So that's a very tough business to invest, especially for long-term investment, right?
So given your focus on the smaller companies, do you see any value at some of the bigger names that perhaps are much wider known in the West? Is there anything that you find attractive?
I mean
in the big cap space?
Well, like some names, but I think it's a well covered area. Even many people doesn't really look at Japan, but some people still looking at Japan. And then like a lot of the value guys, like a company called Secom, they are a security company, and then it's a great business, and a very high market share. But their security business has 25% or so operating margin, but the Secom itself on a consolidated basis, its operating profits are like 15%. So they're known. They don't call it non-core, but their non-core businesses are such a low margin. Maybe some of the businesses not even making money businesses. And then Secom has been looking for another very profitable business, and they haven't found it yet. So and then he went into real estate development business, and they made a huge write-off in the business. So and I think it's trading at maybe 5-6 times EBIT, and I think it's very cheap in terms of global standards, or maybe it's very cheap. But I think the Secom has a problem in allocating capital. They kept allocating capital to new business and other non-core businesses. So until they keep doing that, maybe it may stay trading at 5-6 times EBIT. Maybe there's some chance you can buy it at a much cheaper price, but it's it's hard to someday it may trade at the 10 times. If you sell a security business to a private equity firm or something, easily you can get 10 times EBIT, 12 times EBIT. But that's very hard to imagine that will happen. So it's very cheap. I understand that, but I'm not sure how it can get the fair value in the future.
So help us understand a bit more about this whole issue of what's called engagement or activism. So how do you look at it? For example, with your approach and the way you engage with the management as a CEO, how far could you go? For example, would you acquire a company? And what are your concerns, and what strategies do you think work and which ones don't work?
Well, we haven't found what's the the way it works. We still kind of still trying to searching what's the right strategy to. But I think discussing the fair value of the company, I think that's the right way, and then that's the one thing CEO and management see as adding value, because that's our business, right? Valuing a company, and they try to find the undervalued situations, and then they love to talk about the competitors buying other company, and then what kind of multiple they are paying, and then trying to let them understand how deeply undervalued their shares are. I think I think we found it that's a good start to begin with. And then if the management understands the share price is very undervalued, maybe we can discuss next step. Maybe you can buy back your shares, increase dividend, maybe use the cash wisely to buy some other business. And then, but the other approach is, there's one firm is doing interesting approach. It is they just kept buying the shares in the market, just kept buying, keep buying until the company said no more, and then they did it with a few companies, and then one case they accumulated shares under 44% or something in the market, and then their sister company made a bid for the whole company to rescue the company.
When you say sister company, what does that mean?
Well, they were 20% owned by. It's not a parent, but they were same company before, and they separated. But this company was still 20% owned by this company, and then when the fund is accumulating shares at 45% or so, the sister company made offer to buy the whole thing, and then that worked.
But that wasn't done at a premium, or was it?
They paid a big premium. They did pay a big premium. Not a mistake. We didn't lose money, but we made an investment with listed subsidiaries a couple of years ago, 2 years ago. 2 years ago. In Japan, there's over 300 companies listed, but they are also more than 50% owned by their parent companies, and we call it like listed subsidiaries. And then those companies are very cheap for, I guess, obvious reason. They are controlled by the parent, and then their board members mostly come from the parent companies. And then some case, those listed subsidiaries are usually very profitable subsidiary. That's why I guess they go public, but they went public. So since they are so profitable, some case they lent the money to the parent. So the company had decent business, very strong balance sheet, and then if they, instead of paying the cash to investors as shareholders or buyback, they just lent the money to the parent. And then we made an investment with 20 such companies, and then I would say 6 or 7 of them were taken over by parent. And then the parents have been buying back those minority stake because they want to. There's some some people say that's a bad corporate governance practice, so they want to improve. And then some large company want to own 100% of profitable business. So there's a trend of such parent companies buying back those subsidiaries. And then the first couple acquisition in our portfolio, we got decent premium and decent multiple, and then so we were happy. But we started seeing very undervalued acquisitions like last 6 months or so. Even one case, company was acquired below net cash. The parent paid maybe 10-20% premium, but the acquisition was done below net cash level, and then they paid in the shares. So and then we try to understand why that is happening, and then I think the reasons were there's enough cases, and then if you don't like the price you are getting, you can vote no at the shareholders meeting, and then you can you can make a demand to repurchase your shares to the company, and then companies are required to buy your stake at the fair price. And the fair price is you can discuss with the company for 30 days, but then if you don't agree, you go to court. The court will determine what's the fair price. And then we had some cases in that repurchase demanding things, and court cases about fair price. And then court have been very much focused on the process of the negotiation of the two companies. And then so the court want to see the company well explained why they are buying back the subsidiaries, and also the court want to both company hire independent financial advisor to do the valuation work, and also the court want the target companies independent board member sign up some fairness opinion type of letter saying this deal is not unfair to the minority shareholders. And then so now companies learned what are required to do such mergers. So they know how to do it. So now I think they got a little bit wise to buy them at very cheap price, but still complying with requirements by the court. So I found it's a little weird. So when we talked to the company which were acquired below net cash, and they said, so I don't see them doing anything illegal or anything in breach of law or rules. Everything is 100% perfect, but their price is just not right? But so we start seeing such very low price acquisitions in between the parent company and subsidiaries. So we kind of getting out from the such investments.
So you don't think there is any real recourse to do anything about it?
Because it's difficult because the court doesn't really get into a valuation when they determine the fair price. So it's funny because if the purchase demand case is happening in private companies, courts will use DCF, comps, various valuation metrics. But in public companies, they see the last price of the market is a fair price. So they're assuming the market is a kind of efficient, I guess. So they don't really get into variation metrics. So
just to follow up on the example where you talked about the company where someone had been acquiring the shares on the market, getting to about 45%.
Right.
How does that actually work? Isn't that creeping control? Isn't there a provision where if you cross 30%, you have to make
that's typical for other market, but in Japan, maybe you should ask the lawyer. But my understanding, as long as you keep buying in the market, not the out of the market, you are not required to make the offer for the whole company. So if you do the transaction outside of the market, to be fair to other investors, you have to make the offer to the whole company. But as long as you are buying in the market, which everybody can sell, you don't have to make the bid for the whole company. That's very. I think maybe other markets doesn't have such a rule, but in Japan that's the rule. So
I guess the other option would have been to issue some dilutive securities or poison pill type.
The bulldog case, right?
But so they opted for the sister company to
right, but
rescue it.
but so I think they pick the companies doesn't have, which doesn't have the poison pill. Right. So the company didn't have the poison pill. That's why they kept buying the market, and then when they acquired more than a third, I think company and a sister company see it as a potential risk still being public, so they made offer to the whole company. So
Let's move on to, I'd be interested to also understand a little bit what trends or what developments do you find really matter and which ones are less relevant. For example, a lot of people in the West talk about the bad demographics in Japan, or the bad economy, politics.
right.
What about some other trends that are perhaps missed by the West, when it comes to more structural type issues, even as the development of the MBO market or some
Right.
corporate activity that seems to be resurgent a bit.
Right.
Can you talk a little bit about some developments that I guess
Maybe
make you interested in?
But we like to invest with the companies which has like a dominant market share in Japan already. Even Japan has negative growth or deflationary economy, because if the company has dominant market share, it can keep making money anyway, even demographic is bad or economy is bad. And then we found those companies usually has good technology and then, some edge to maintain the market share. So and this company can grow, go to other country to grow globally. So we found that that's the one area. Those companies that just happen to be in Japan, but they kind of try to be a global company. So they don't need domestic economy, grow to grow their own business. So so there's many companies like that. We have investment with a company called Medikit. They make catheters for dialysis and also catheter for like IVs. And then they have very dominant market share in Japan. And then they're very profitable. And then the healthcare business is still growing in Japan because of the aging population. So next maybe 10 years, 20 years maybe, their domestic business will grow. But the after that, maybe, start shrinking very rapidly. So they need to, they understand, next 10 years or so, they need to grow overseas. So so for us, and then those companies at Medikit was trading around cash, maybe now trading at 1 times EBIT or 2 times EBIT. And then for us, waiting, next 10 years, okay, domestic business, and then buying a kind of free option if they succeed for the foreign business, that's gonna be a free option for us. So there's a trend between Japanese companies, they well understand issue of economy and demography, so they try to grow overseas. So and then some people can do it. So and then if it's not priced in to the share price, you are not paying for that option. So we found it that's a good way to invest in Japanese companies. And also the management buyouts is happening, but the I also, there are like 3,700 Japanese public companies, and then many of them are not. They don't need to be a public company because they have so much cash. They don't need. They will not. They don't need a capital raising. But the so if they decide to go private, there's many private equity funds in Japan. They're happy to help, and also management can make a lot of money by doing that. But and still we're seeing MBO maybe 10, 20. So it's not so many yet. It's a lot of managements are not motivated by the money they can make. So I think it's not there yet. It's happening, but we don't see there's some common characteristics between among those companies who went private. We made an investment with a company called Oaknet. They provide an auction service for used cars, and then we made an investment because they were doing auction through a satellite network, but they were changing satellite to an internet-based auction, and then they were spending billion yen every year to keep the satellite network, and then when they exit from the satellite network auctioning, their operating income will increase by billion yen from next year. So we find that's maybe a good way to invest. There's some value for the business. And then right after they announced the exiting, right after we met investment, they just decided to go private. So it's happening, but it's not enough many yet, I think. But there are so many companies which should do it, but they're just not motivated by money, and also they just want to keep it as a public.
Is there a certain status,
there's
recognition that comes with that, and the CEOs very much want?
It's hard to confirm it, but they say if you're a public company, it helps to hire good people, and also even employees who works for public companies who can get better loan to the banks to buy a house. So, but it's hard to confirm it,
That seems a bit difficult to understand, especially if, unlike in the US, where you can justify it with stock options or to attract employees, based on some incentive compensation tied to the share price. If in Japan the majority of companies don't necessarily care about the share price, or then it's
right.
difficult to really incentivize your employees with their argument about being a public company doesn't seem to really hold water.
Right.
If you don't really do anything to care about where your share price is.
And then the cost of being public in Japan is not that expensive. I found somebody told me the fees to the accounting firms, like auditing firm, was very cheap in Japan. Somebody said I didn't have the exact number, but somebody says U.S. companies are paying a couple $1 million at least for such auditing company, but in Japan the cost was like $100,000 or something like that. So.
What would you say to people who are open-minded about some of the issues in Japan and are willing to go beyond the simplistic reasonings and see the opportunities in various pockets as you described them? But then this question of why now, certainly as a value investor, we don't care much for catalysts. If something's cheap, you buy it with a long-term vision and ability to hold for the long term. But if there was a reason why you would say now is a good opportunity, what would that be?
Besides valuation?
Right.
Well, why now?
Or I guess, has anything really changed over the last year or two that makes you more confident, or is it kind of business as usual and
I think
you're finding the specific opportunities and that's all that matters? Or is there anything that, okay, you could see for the broader market some expectation that things could get better overall?
But I think you have to be very carefully pick the right company in Japan. But I see the management are started understanding more about the value of the business, because they are looking at a lot of foreign acquisitions now. Maybe I see many of them are overpriced, but some companies start valuing company, and then when they want to buy foreign competitors, paying like 10 times EBIT, 12 times EBIT. But when they look at their own shares, it's trading at like 3-4 times EBIT, and then maybe they should just buy back their shares. And then so as they do that kind of exercise, valuing foreign business, thinking about the potential synergies, and then I think that's a good exercise for them to learn about how to value business. So I think that process will, at the end, will make management in Japan more understanding about the fair value of their own business. And then when they are buyer of the whatever business, they maybe think about the what's the right price if they are seller of the business. So I think that kind of exercise is good for good educations for a lot of Japanese management, I think. So.
And I guess what many people don't realize also is weren't Japanese companies, they weren't even allowed to buy back shares, let's say, before the mid-90s.
Mm-hmm.
So there are certain, even though it's very slow, but there are certain developments that are leading to more.
I think many companies are doing buyback, and many companies are doing increasing dividends, so they do care about the paying something to the shareholders. But we're still having tough time telling them. So like we met with the company, the CEO, and then we discussed about the how he sees about the share price of the company, and then many people just talk about net asset. So our net assets per share is like 1,300. Our company should trade at 1,000 shares, so we're undervalued. That's the many cases, but they don't really have. They don't talk about the return on equity. If your return on equity is like 2%, it's hard to get your share price is valued at net asset, because you are destroying value there. But the cost of capital, cost of equity, and try to improve the return on equity. That's kind of a still very hard sell to the management. Some management get it, but I think majority of Japanese management, they don't really understand the concept of salary. But so
is it really that they don't understand the concept, or is there really something else behind that?
Yeah, it could be something else behind it, because if you talk to like a company with huge net cash, simply that makes management comfortable. They, the cash balance makes them sleep well. So and then they talk about if earthquake hit the factory, maybe they need 10 billion yen to build a new factory. But I think a lot of companies are trying to come up with what's the right cash balance they should have, considering a lot of worst case scenario. I think that's good to think about it. If you're looking at the company like Keyence, Keyence has 500 billion yen cash on the balance sheet. So their market cap is 1.2 trillion yen. It's like a 40% of the market cap is in cash. And then if you talk to the company, they are not trying to grow the cash balance to trillion yen. Then they are not. They start seeing maybe 500 billion yen could be enough money to have. Finally, maybe. So the future cash flow, maybe they change the way to allocate the capital. So when we talk to the company, the cash they already have, it's hard to sell to make them pay a big special dividend to pay out those cash. That's kind of a hard sell idea. But when I talk to the company, like, so you have the 80% of your market cap in cash now. So, and then try to convince them that's enough cash to have. And then they said, okay, that's a lot of cash and maybe enough cash. And then so future cash flow, maybe that's kind of different subject. So the cash they don't have yet. So we can talk about so maybe you have enough cash already going forward, pay out 100% of the cash flow as a dividend or something. I think I see that's the room, they're kind of acceptable, that kind of idea. So, but I'm not sure in the corporate governance, I don't see there's a big improvement there. Maybe there's a government committee discussing about changing corporate law in Japan. And they there's one idea, they try to make public companies required to have independent board member. But that's kind of, that's not happening. So they said that's not going to be a law. So
what do you think is the biggest mistake that foreign investors make in Japan?
Well, biggest mistake. Well, it's I don't know. I see a lot of foreign investors still making money in Japan. They see, if you looking at some value guys, of course, like some big headliners were kind of kicked out from Japanese market, but there's true long-term value guys kept investing in Japanese companies, and then I think they are making money. I don't know. So I think if you're a foreigner trying to so there's one common answer when we talk about return on equity with the management. Some Japanese CEO says, "Oh, that's American way." So that didn't work. You see, the Lehman Brothers blew up, and there's a lot of so somehow the way Americans management run the company, some Japanese people think doesn't work. That's the Japanese way is the right way. So these days I'm still sort of not fighting, but arguing with Japanese management. Maybe there's some excessive. Maybe some American companies try to maximize return on equity using maximum leverage. That didn't work, of course. But there should be some balance between, 80% of market cap is net cash, or maybe 100 times leverage. There should be some good balance between some optimal point of right strong balance. We are happy to see the company has strong balance sheet. But not to excess. So if the foreigner come to Japan and is saying, our way, American way is the right way to do everything, maybe that doesn't really work always in Japan, because maybe that could be the one mistake. Try saying the way Japanese management is doing is wrong. Maybe that's not a good message to tell them.
What about some books or resources that you could recommend to investors who are new to Japan? Could you share with us anything that we could should study, or even some business people that, of course, there's this notion that Japanese management doesn't really get, the return on equity, for example, or governance is bad. But who are some of these shrewd business people that are building businesses, creating value? Of course, there are so many great Japanese companies, some of the best in the world. Who should we study?
Who I don't know, but if you see any Japanese companies which have great margin, if you go to the company and ask the CEO simply, why your company is so profitable, and they are happy to discuss and explain where the margins are coming from. Like a Nagai 11, the nursing uniform company, they make they make a nurse uniform for nurse, but their operating margin is like 28%. It's a very simple product, but they've been maintaining a very high profit margin. And if you ask the Mr. Sawanobu, CEO, why so your profitability is so high, and then he'll explain to you, like expanding our why it is. So I'll recommend any foreign investor to come to Japan and then discuss how they make money with Japanese management, and then some of them are very impressive. I don't think there's a one role model, but and there's a but I guess nobody's in Japan is there's no like Jack Welch or in Japan, or there's no Warren Buffett in Japan yet. So but you have to talk to each CEO to discuss the business. They're great. They're very good at running their business. Their capital allocation is not so good at it, but many company can be one of the Berkshire Hathaway operating company easily. They just need to give up. Well, they just need to understand a little bit about capital allocation, and then that little understanding can be home run for in terms of share price.
But if the return on equity equation is wrong in Japan because of the huge equity base, then that is a much in a way a much easier problem then. So they have good earnings. It's just that the return on equity is low due to the large capital base.
Right.
Then there is much room for optimism here, and in a way it may reflect the deflation, right? Hoarding cash is a logical response to deflation. So,
but I think last 20 years in Japan, people are, they're very cautious about the running the business. I think right now U.S. companies are like that. So instead of building new factories, they try to improve the utilization of the factory instead of building a new one. So their profitability and then the way they deploy the cash decrease, but their profitability maintains. That's why their cash has accumulated. So, if you take a look at the cash-rich companies in Japan, uh, the cash were earned by the business. So we happen to, if you go to many cash-rich companies and how they get that cash, it's usually they have good business, and that's why their cash has been accumulated. So that's what John Ray said once to me. The reason why we look at the cash-rich companies because cash-rich companies tend to have good business, and so.
What have you learned from working with Jean-Marie Abelard?
Well, I think the way he used his common sense to valuing business or understanding making investment. I think that's what I learned. Anything he says it is not so, I guess, complicated to do it. Way value the business, but I think his conviction to value investment philosophy, and then doing that in any market environment. I think that's the one thing I should learn. I'm not there yet, I guess, but.
So is there anything for us to study in terms of understanding better the Japanese mindset, the CEO's mindset? What are some of the books or resources that one could study?
So there's a lot of books about the Mr. Honda of Honda biography and Mr. Morita of Sony, but also the one we always do is when we visit a company. In Japan, it's many companies has their own history book. Every 25 years anniversary or every 50-year anniversary or 100-year anniversary, Japanese companies usually hire a writer and then to let him write about the history. And then we always ask to show us or give us a copy of such history book, and then read them through, and then you learn how they start the business, what was the first major product, and then they always talk about the difficult time they had in the past. And then sometimes when you talk to some cash-rich companies, the one of the reasons tend to be at the initial stage of right after they start the business, they usually have some financing problem. So many CEO remember there's such a difficulty starting the business. That's why they kind of stick with they feel very comfortable sitting on large amount of cash on the balance sheet. So I think I'll recommend to ask to get a copy of such a history book of the company. So.
Yasu-san, thank you so much for your time and all the insights.